Insurance policies are basically three types. There's something known as endowment policy. So, and in an endowment policy, the company will give you a part, will give you a bonus. Now, this bonus depends on the profits that the companies make. Now, my understanding is most of these companies will never be able to pay you bonus equal to your PF rate.
That will be there, yeah.
So, if you are getting, therefore, it does not qualify as an investment because you can earn more in a PF. Now, the point to see is that, they sell it as a combination of insurance and investment.
I'll just button, like I have been a proponent of having a PPF for those who are not into government services or corporate. A PPF is generally in the range of 7 to 8% depending.
7.1.
Today it is 7.1, it might go up a bit. So this is in the range.
Yes, sir.
Anywhere where you go, with the tax benefits which you get with PPF,
correct,
you will never get in any type of FD until as your interest rates in the country goes up to 10% or 12%.
Correct.
So it is a very, very good investment. And what you were saying, that instead of going for that endowment and other things, just go for term and put the balance into PPF.
Correct, sir.
You will be much better off.
Correct.
Okay.
So we will come to term insurance, but endowment policy, we said that, mostly the agents tell you, you pay this much every year and then after 5 years you'll get so much. At the end you will get so much. So the numbers look very large.
Yes.
The trick is, do not fall into that trap. Actually, you need to learn a formula which is known as XIRR. Put the numbers on that formula and calculate the return that you're going to get.
That's right.
In this formula, we're going to learn how to calculate returns. Now, the example that we have taken is of an insurance policy. Let's say somebody comes and tells you that, sir, we have this option where you can, you need to pay 2 lakh every year for 8 years, and then having paid 16 lakhs, you need to wait for 2 years and then you will get some amount, let's say 26 lakhs. Now, how do I want to know what is the percentage return that I will get. So, for doing this, all I do is, you open an Excel file and I select 3 columns, date, amount and remarks. Now, first I need to format these cells. So what I'm going to do is select the column of date by first clicking on the left side of the mouse on column A, and then I right click it and these options open. I will select format cells. It will initially be at general, so I need to select date and I select the date format that I want to. Let's say I want to select this format. So I select this and I say OK. So this is the amount. Now I need to format the column for amount also. I left click it, right click, come to format cells and come to, from general I come to number and then select, I can select decimal places 2, 4, whatever, or 0 decimal also. So I'm going to select 2 decimals and then I say OK, and remarks is a text column, so I'm not going to worry about it. Now let's say my first premium I paid is on 20th of June 22, I paid 2 lakh rupees. Now the rule to remember here is, in XIRR, any amount that is going out of your pocket or your bank that is getting invested will be entered with a negative sign, and any amount that is coming back to you from that investment, in your bank or your pocket, is written with a positive sign. So because I have paid this money, so therefore it is with a minus sign. Now I select this, I copy this like this. So the same date has got copied, but I want to change the dates. So I just select this and I select fill years. Now what has happened is, on the same date, the years have changed. However, we need to change the last date from 30 to 32, let's say. The amount will remain same, so I can just copy it up till the time I am paying, and premium also will remain same. Now the last one is my maturity benefit. So this is the amount that is going to come back to me, and let's say I am getting 26 lakhs. Now because this money is coming back to me, I write it with a positive sign and I want to find out the returns. Now for calculating the returns, what I am going to do is, I am going to use the XIR formula. Now in Microsoft Excel, whenever you want to write a formula, you have to start the formula with is equal to sign. So I write is equal to, then followed by XIRR, and then I open the bracket. It is telling me to select the values. So I select all these values, all the amounts that have gone from my bank and come back to my bank, followed by comma. Now I select dates. So I select dates and I close my bracket and followed by into 100. Now in Excel, into is represented by the star symbol, so I enter star and 100, and then I enter and I find out that my returns are 7.52%. So what looked like a very good investment is actually not that good. Now you can use this formula for calculating returns from your insurance policies and from your property. Let's say you buy a property, you give initial amount and then pay some more. You start paying EMIs, and then you start getting some rent and finally sell it. So you can put all those numbers with dates and you can calculate the returns. Now the agent is trying to sell you a policy. He can sell you by telling you 20% also. You should not fall in the trap. When the policy document comes to you, you have to read.
Yes.
There's a friend of
that is the reason they make a policy document in 60-70 pages.
And the font size is so small, sir,
that you are dissuaded from reading it.
Correct. So a friend of mine who's today a Lieutenant General, he sent me he told me that my agent is telling me that I'll get 8.5% guaranteed returns. I said not possible. This is about 4 or 5 years back. I said impossible. He said no, he's given me a document. I said share the document. So now in that, there were 2 stars next to 8.54. So I went for the stars. Now what it said was 8.54% of the sum assured.
Okay.
Now you must try to understand. You are paying a premium. Whatever returns you are going to get should be on this premium, and not on the sum assured. Sum assured and premium, how are they linked? You don't know. So if you are paying 100 rupees and you are getting 8.5% on this 100 rupees, it makes absolute sense.
Yeah.
But they will tell you on sum assured, so therefore please don't fall in this trap. So endowment policies don't make any sense whatsoever. The next type of insurance.
And this is the policy which the insurance agents strike to.
Yes, it is
push
the maximum.
Because you, with that lure of earning at a particular time in life, you keep paying the premiums.
Correct.
And he keeps getting the cuts from that.
Correct.
Commissions.
Now, something I wish to highlight here, we are, both of us are saying the same thing over and over again, do not invest in insurance. So, why should you trust us? So, firstly, there are 2 resources that I am going to share. First is an article by Economics Times Wealth, which said that 10 financial mistakes you will regret at age 50. So, we'll post the link also in this. One can watch this article there. So, it says, people are trapped. So, the article says that most policies, they bind you into a multi-year contract where the returns are just about 5 to 6%. This part 1. The second is a booklet by RBI, which is called Financial Awareness Messages. And again, you can just ask for it, or you can download it from my Fauji Wealth website. You can just download it. Now, in that also it says that, when you go to a bank, the picture there says that, investor goes to a bank and says that I want to open a FD. The bank manager says, I suggest you take a policy.
Yeah.
So the RBI caption says that do not mix insurance and investment. And this is where I want to highlight that, banks are your biggest culprits. Because over a period of time, the banks, particularly bank managers, they try to make a bond with you. Because you're going to same branch again and again. So they tell you, sir, this is a very good policy. Please do not fall in the trap. It is a bad thing.
That's right.
Now, the second type of insurance policy is called something called ULIP. It is called Unit Linked Insurance Plan. Now, in this policy, what they will tell you is that you give us the money and our company will invest it in stocks, in share market. You don't have to do anything and we will deliver you 12, 15, 20%.
So, basically it has got 2 parts. Like if you are putting, say, 20,000 rupees in that, so 2-3,000 rupees will be covering your insurance, and those 15, 16, 17 will go towards investment.
Correct.
So they are able to cover a bit bigger amount,
Yes, sir.
yet not good enough, and they invest so that you feel that at the end of the day, I'll be earning better than an endowment policy.
Yes, sir.
And it has got some tax benefits also.
Yes, sir. Now, firstly, tax, let us forget for the time being. Sir. But let's only focus on the returns.
Returns.
Because tax you will pay only on part of the returns.
Yeah.
So, your aim should be maximizing returns. Now, I'm going to show a policy, and this policy was taken by a young officer who was 20 years old when he took the policy. And he was told that he needs to pay 2 lakh rupees per annum for 8 years.
Okay.
And the policy tenure was 10 years. He took it 22. Policy was valid till 32. He pays 2 lakh rupees every year for 8 years. And the best part was when you see the first policy receipt, out of the 2 lakh rupees paid, almost 24,000 has been deducted by the company as charges, 12%.
Oh my God.
12% in the first year. Now, if you see the charges over the 5-year period, it comes to an average of about 6.4. Now, here is the catch. If he has taken 12%, to just give zero returns, now he has to give much higher returns.
At least 15-18%.
Correct, sir. And this is what most people don't realize. So, I give an example. Let's say, the company says, let's say charges are 7%. You pay a premium of 1 lakh. The company says you will get 15% returns. But you get 7.5%. Now, how's the disconnect? The disconnect is they are deducting 7%. So, 1 lakh premium paid, 93,000 is getting invested. This 93,000 is giving you 15% returns. You are getting 1,07,000. So your returns are only 7%. Even if the company gives whatever, it is the returns that you have earned. So ULIP, again, the charges are very high and therefore does not make sense. Also, the sum assured in ULIP is usually 10 times your premium paid.
Okay.
So again, somebody is paying 2 lakh rupees and is getting a sum assured of only 20 lakhs.
It's nothing.
It's nothing, even today.
Yeah.
And just imagine what's going to be the value after 10 years.
Yeah.
So therefore, does not make sense. The best kind of insurance which is available is term insurance. It's a pure insurance. Most people don't understand it. So in simple words, a term insurance is a policy which is like your car policy or your bike policy. You pay the premium and nothing happens to your car or bike at the end of 1 year. The premium paid earlier goes down the drain and you have to pay premium all over again.